Lyn, it's a pleasure. I'm honored having you on my show. It's the first time you're on a German channel, so thank you very much for your time.
Happy to be here. Thanks for having me.
Yeah, definitely. You were on my list on number one, actually. So you're one of the few women in the space talking about macro, and I think we need much more women in the space, of course. So yeah, because it's a men-dominated area, actually. So first of all, to all our viewers, you have to check out Lyn's website and your fantastic blog. You wrote a blog post about Ethereum, which is definitely mind-blowing. I will put the links in the description, of course, and you have to check out her website. I'm also actually a subscriber of your paid newsletter. We talk about this later, which I really appreciate. I have some questions about your portfolio, but that's later. I love reading your stuff, so check out the homepage, the webpage from Lyn. But now you have to introduce yourself to our audience because it's the first time you're on a German channel. So please give us something about your background. Who is Lyn?
Yes, I appreciate so much for you having me here. And my background is a blend of engineering and finance. So I initially went into electrical engineering, and I worked in that field for a while. But eventually, I shifted more towards engineering management. So I got I focused on financial modeling, engineering economics, overseeing engineering teams. And then on the side, I've been an investor since I was a teenager. For at this point, I guess it's going on 18 years or so, depending on exactly where you measure it from. And so several years ago, I started a website to just kind of cover investments. And it's done very well. It's most of my content's free. I do free newsletters. I do free articles. But then I also have a research service where I cover things more regularly, more tactically. And so my biggest focuses are on things like equities, precious metals, the overall kind of macroeconomic cycle. And then more recently, I've gotten into digital assets to some degree.
Yeah. So yeah, let's talk about the cycles, the big picture, actually. So what do you think? Where we are at a debt cycle?
So the biggest framework I have for that is Ray Dalio's long-term debt cycle conception, which is the idea that basically, if you have a short-term business cycle, right? So you have, say, a 5 to 10-year credit cycle, debt as a percentage of GDP goes up. There's a big kind of economic boom, and then something happens, or some sort of deleveraging event, or some sort of external catalyst or policy change, and it triggers a recession, a deleveraging event. But then policymakers come in, they do different types of stimulus to try to, kind of short circuit that deleveraging to try to get it to go back up. And so what happens is at the end of that economic cycle, even though debt as a percentage of GDP came down from its peak, it's still higher than the starting point. And so when you string multiple of those cycles together, you keep getting higher and higher debt as a percentage of GDP, and you keep getting lower lows and lower highs in interest rates until you hit around zero, or in Europe's case, even mildly negative. And so when you get to that point, there's not really a lot more room for central bankers to, continue to ease conditions. And then so you get into fiscal stimulus. So basically holding rates at zero while you do large fiscal stimulus and basically, kind of devalue the currency. And so Ray Dalio's conception of the long-term debt cycle points out that monetary policy and fiscal policy get very, very different when you reach the end of that period. And so, for example, we reached in many places the end of that period back in 2008, and so we had the private debt bubble implode, and then now we're kind of on the second stage where it's more of a public debt bubble that's kind of coming to fruition. And you really have to go back to the 1930s and the 1940s to find the last time that rates hit zero, and basically debt levels as a percentage of GDP were this high. And so, a lot of people point out, they look back at the 70s, for example, when they want to see inflation. But in many ways, the environment we're seeing now is a lot more like the 1940s. There's obviously some differences when you go that far back, but the overall kind of macro landscape of where we are, that long-term debt cycle kind of process is probably, I think, the one of the more accurate frameworks to understand these kind of unusual times.
Definitely. I also mentioned the debt cycle from Ray Dalio in my new book. So you're also familiar with the fourth turning from Neil Howe and William Strauss. What's your take on this?
Well, I mean, it's funny because it's kind of a different way of looking at the same phenomenon. And so if you look at the list of fourth turning dates, they also happen to correspond with the peaks of the long-term debt cycle. And that's so the long-term debt cycle is kind of the more quantitative description of what's going on there. whereas the fourth turning is the more qualitative description. So the social changes that are happening, the generational shifts that are happening, and generally when you get towards the end of a long-term debt cycle, you get rising populism because you have things like high wealth concentration, you have various sort of economic or monetary bubbles, and so that starts to manifest itself in people that are understandably not happy with the system as it's currently structured. And so when that starts to happen, you get rising populism, and then you generally get some sort of big shift in terms of the way politics is working. And one kind of framework I like to think about is the kind of the pendulum of power between, say, labor and capital. And so there are kind of these multi-decade trends where, say, labor gets more power, they can do labor unions, and so there's obviously for each one of these cycles, there's advantages and disadvantages. So workers get higher wages, but you also tend to be more inflationary. You can potentially be less competitive, right? Because you're basically kind of artificially boosting up the power of labor. On the other hand, when we have technology allows for globalization, or we have policies that start favoring money more, that we can kind of put the pendulum in the other direction, where people with capital have a lot more political power. Labor does not have a lot of negotiating power, especially because they have international competition now, and so at the current period of time, we're very, very far in kind of capital's favor. Whereas say back in the 70s, you were more in say labor's favor. And so these kind of long-term trends, I think, are worth watching because, we look back 5, 10, 15 years in financial history, and that tells us quite a bit, but we have to go back kind of further to see some of these big rotations that happen and some of the things that can kind of catch investors off guard if they're only looking back 10 or 15 years.
Yeah. So if we see all these cycles, they all tend to show us that we are at the end of the cycles everywhere. So what do you think is the end game of everything?
I mean, I think the general end game, it could take multiple forms, but I think it generally involves a period of currency devaluation. That's kind of the outcome that most of the possible end games have. And that can be an abrupt devaluation. Like for example, in the 1930s, there was the gold peg
Yeah.
devaluation. Or you can have a more gradual devaluation, which is that you run inflation levels higher than interest rates for a period of time. And so, for example, in the 1940s, you had 6% average inflation, while interest rates on the short end were kept near zero, and even long duration rates were kept at 2.5% because they did yield curve control. And so you had these big inflation spikes. Sometimes you got as high as in the United States, you got as high as 19%. You go down to zero and then go up back to like 12%. And the average for that decade was 6%, while interest rates, did not keep up. And so, you can have different types of devaluations that occur. They can be abrupt or they can be gradual. But generally, when you get in this environment, policymakers do whatever they can to run inflation higher than the prevailing interest rates.
Mm.
And so, from there, we can potentially see political changes. It'll obviously vary from different countries, right? So the United States has different politics than Germany, which has different politics than Japan, which has different politics than China. And so we'll see it kind of manifest itself in different ways around the world.
Mm-hmm. Yeah, so the big topic right now is inflation or deflation. The inflation camp is very strong right now because we see fiscal packages, we see monetary stimulation, we see open societies again. The lockdowns are over in many countries. So you have written some excellent and outstanding blog posts about inflation and deflation on your website. Can you give us a brief rundown? Where do you see the economic heading? Is inflation transitory, like Paul said?
Yeah, so for the past couple of years, I've been pointing in towards a more inflationary direction, and we've been seeing that manifest this spring. Especially in the United States, but also in many other developed countries. Different countries obviously have different levels of inflation. They did different levels of fiscal and monetary stimulus. And so, for example, the United States grew its money supply at a peak rate of over 25% year over year. Whereas if you look at Japan, if you look at the Euro area, it was more like 10%. And so some of the countries basically had just kind of more firepower added to that is potentially more pro-inflationary. And so, my overall case is basically, again, kind of, looking more at the 1940s as a model than the 70s. So in the 70s, you had this kind of, you had waves of inflation in many countries around the world. But, a lot of my data sets focus on the United States, but I often kind of then compare it to other countries. But basically, a common denominator you had in the 70s was a lot of the inflation was from bank loans. And so you had money supply growth from bank lending, as well as some fiscal deficits on top of that. Whereas if you look back in the 40s, obviously you had the World War, and so you had, in the United States, for example, you had massive fiscal deficits, and so it was very fiscal-driven inflation. Banks were not really lending much, and instead the government was running large deficits, and then the central bank was creating new bank reserves in order to buy the treasuries associated with that fiscal spending, and that increased the broad money supply. And so, you got these spikes of inflation, and then after that inflation would subside, it's not like prices went back down to where they were. They just kind of leveled off. And then there was another, say, fiscal spike, and then prices would go up again. And so you had these kind of stepwise increases in prices. And so I think we're in that kind of environment where we won't have just continuous inflation getting higher and higher and higher. Instead, it's largely going to depend on what fiscal policymakers do. It's going to depend on what energy markets do. Because you have periods of commodity tightness or commodity looseness, and so there's a couple different factors at play. But my overall base case is that in the 2020s we'll see these periods of inflation, and while interest rates will generally not keep up with those rates of inflation, and so this particular spike that we're experiencing now, I don't expect it to be permanent. It could last longer than policymakers think, but then it'll come back down. But then, it's ripe for potentially another spike after that. And so I think that the general trend will be, regardless of the exact shape of inflation we experience this decade, that for the most part, inflation will be running hotter than interest rates.
Okay, so what does this mean for the dollar? Where do you see the dollar in the next couple of years?
So it's pretty not a great picture for most fiat currencies, right? Because most currencies are in a situation where if you're holding money in a bank, if you're holding sovereign bonds, many cases even corporate bonds, your return on your investment, your yield is failing to keep up with inflation. And some countries are, some currencies are more prone to devaluation. And so the dollar's been in a pretty strong period for the past 5 years. And so generally in a very kind of looser environment, the dollar has more room to fall, right? So, for example, Europe as a whole is running a current account surplus,
Yeah.
and so that tends to hold up the currency to varying degrees. So there's tons of problems with the euro, in my opinion, but overvaluation isn't really one of them. Whereas if you look at the United States, there's a lot of good things about the dollar, but one of the problems is that it's essentially overvalued, and so we kind of run these structural trade deficits. And so if we continue this sort of pretty loose policy, I do think we're prone to, say, the dollar going down to some other major currencies. But I think the kind of the broader trend is that most fiat currencies will be devalued compared to hard assets.
Yeah, that's a good point, actually. So what do you make of the last FOMC meeting where Powell said perhaps in 2024 we will raise interest rates? Is this possible?
I mean, it's possible. I think, if they were to try that, beyond a certain point, they probably would run into the same problem they experienced in, say, 2018, where they quickly find that the ceiling for how the high they can raise interest rates before financial markets start, crashing is not very high. But so, and even at this meeting, it wasn't even Powell himself that said it. Basically, they showed the dot plot of various Fed leaders, and some of them pulled forward the dots that they had before. So they basically, on average, if you look at the range of estimates, they pulled forward their expected rate rise by a year. That doesn't mean they're committed to it. They can change that based on economic conditions between now and then. But basically, it slightly pulled forward the market's assumption of when they might try to taper asset purchases and when they might try to raise rates. And so I do think, for example, we're going to see reductions in the purchases of mortgage-backed securities, at some point in maybe the next year or so. Treasuries are going to be harder to wind that down because treasury deficits have been so big. The foreign sector is not buying a lot of those treasuries, and so the Fed's kind of found itself as a pretty big buyer of those treasuries. But depending on economic conditions, you could shrink the rate of those purchases. And so I do think that they might be able to slip some rate increases in, as we go deeper into this decade. It's just very, very hard for them to do so, more than a few rate hikes, because then they start running into asset valuations coming down. And the United States in particular, our stock market is like 200% of our GDP. And so, we're a very financialized economy. That's not the case for every economy in the world, right? So if Russia's stock market goes down a little bit, it doesn't really change their economy. Whereas the United States, it's like the tail wagging the dog. If our asset prices go down, it actually impacts consumer spending and things like that. And so, I think that they're going to probably have trouble raising rates. And that's why, for example, I use the 40s as more of a model than the 70s, because in the 1970s, both public and private debt levels in the United States and many other countries were much lower as a percentage of GDP. And so when you had bank-driven inflation, you could then raise interest rates to combat that inflation without rendering everything insolvent. And basically financialization was pretty low. So the stock market, the bond market, they're pretty small percentages of GDP for many places. Whereas in the 40s, you had in the United States, you had federal debt at up to 130% of GDP. And so, even when you had inflation, you couldn't raise interest rates. You basically would have fiscal insolvency. And so I think we're more like that 40s case where you'll get these bouts of inflation, and they won't really have any choice other than to keep rates pretty low. But of course, there's some variance for, they could try to raise rates a little bit, and just, the more they push it, the more they run into, the possibility of those financial markets coming back down.
Yeah. Yeah, like you said, we have a big deficit in the US. We have the national debt over $28 trillion. And if they raise the rates, this is a big, 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 huge problem for the government in the US. So they're trapped, actually. They're trapped. So yeah, what do you think? Is a deflationary bust possible?
I think it's possible, but I think that basically policymakers would do everything they can against it. And so
Sure.
we saw that start to play out in March 2020, where you had a coordinated global shutdown around the world. It kind of, it started in China, came into Europe and the United States, spread elsewhere. And so when that, happened, we saw asset prices went straight down, the dollar spiked, right? Because, these countries around the world have dollar-based debts, and they rely on the flow of dollars in order to service those debts. So if trade slows down, they have trouble getting dollars, and everybody kind of scrambles for dollars at the same time, like a game of musical chairs.
Yeah.
And so, it had all that playing out. But then the problem is you start to get markets actually breaking. So, for example, the foreign sector began selling some of their treasuries, especially their long duration treasuries, in order to get dollars. And so the treasury market in the United States went illiquid. So the bid-ask
Yeah.
spreads between what should otherwise be a very, very liquid and safe market basically broke. It was essentially a broken market, which is pretty remarkable. And so, the Federal Reserve had to come in, and they bought $1 trillion of treasuries in 3 weeks. And then they haven't, they slowed down that rate of purchases, but they haven't stopped since then. And so that shows kind of, if things, with the United States having a negative net international investment position as low as it is, right? So for example, Germany has a positive net international investment position, meaning that collectively Germans own more foreign assets than the entire foreign sector owns of German assets. You are basically a net creditor nation. The United States, we used to be the world's largest creditor nation, but now due to running structural trade deficits, and the foreign sector buying so many of our assets like stocks, bonds, real estate, we have like negative 60% or more of net international investment position compared to GDP. So if basically if foreign sector has to sell our assets for any reason, especially treasuries, we can get these kind of abrupt periods where the Federal Reserve kind of has no choice but to step in and reliquefy that market. And so I think we're kind of in that situation where you can have these periodic busts, but generally, in an environment where policymakers have the printing press, they'll always choose to print rather than allow a deflationary bust. And so if they were to do nothing, then yes, you could very much have a deflationary bust, given how much debt there is.
So what do you think? How long can this game go on? That they always bail out the financial market, print more money, and lower the interest rates? Is there an end, or is it endless?
There's a couple potential ends. One is you could have increasing political pushback against it, right? So back after the 2008 crisis, you had the Tea Party in the United States on the right side of the political spectrum. You had Occupy Wall Street on the left side of the political spectrum. That was kind of pushback against the fact that banks were bailed out, but homeowners were not bailed out, right? And so they're basically kind of pushing back against the Cantillon effect, the tendency for wealth to concentrate and for people closer to the money source to get better access to that money. And since in 2020, it's been a little different because more of the stimulus efforts have been focused on businesses. People got stimulus checks, and so there's been we had kind of the waves of civil unrest earlier in 2020 against the lockdowns and other things like that. but that's kind of subsided for now. But overall, if you were to get a more structural political pushback against some of this and change some of the policies, that's one way. Another way is that basically if the Fed finds themselves up against pretty high or pretty persistent inflation, it's generally challenging to maintain that. And so they'd have to resort to something like yield curve control, and then you have a more aggressive currency devaluation, and they basically would damage their credibility, and that potentially kind of ends the cycle, right? Because one way to lower debt as a percentage of GDP is to inflate it away. That's generally how a long-term debt cycle ends compared to a short-term debt cycle. And so I think in some ways that's almost inevitable, where we kind of go through this period of currency devaluation. And so I think that the way it could potentially end is you have enough currency devaluation that debt is ironically reduced compared to GDP. But that's not a particularly enjoyable process, especially for people that have large positions in cash or bonds.
Yeah, they will lose, definitely. So with this knowledge and with this macro situation, with this paradigm shift we're in, how do you invest in these times? What do you recommend?
I think it obviously is going to depend for different types of investors. A lot of my focus is on, I think, equities in general are pretty, depending on what type of equities you buy, can be pretty well positioned. And so generally in more inflationary times, generally value stocks hold up better than growth stocks, but of course it can vary. You can have individual growth stocks do very well. You can have individual value stocks do very poorly. But overall, we talk, for example, about highly valued US markets. And that's true for a lot of companies. There are a lot of highly valued stocks in there, but there are also stocks trading at 8 times earnings or 10 times earnings, right? So there's a very big gap between some of the say software companies versus healthcare companies or energy companies, for example. And so then if you look out into the rest of the world, most markets, even on a sector by sector basis are generally cheaper than the United States markets. Of course, there's other factors to consider, but overall, I still like, several types of equities in the current market. I also think it's pretty useful to have a commodity segment in a portfolio, so that can include gold, silver, platinum. It can also include energy producers, copper producers, uranium producers, kind of a spectrum of real assets. I also actually like some of the midstream companies, so companies that are transporting energy, especially natural gas liquids, that type of asset. And then I still use a little bit of cash and treasuries as kind of like a liquidity buffer or like a volatility reducer. If you were to get those brief deflationary shocks, it's kind of dry powder you can use to buy some of those more reflationary assets.
Yeah.
And so that's kind of how I'm approaching it. I also have I have a small segment for digital assets, primarily Bitcoin. And so, obviously individual investors have different areas of expertise that they can weight more heavily than others. But overall, I think it's an environment where you want to have generally real assets with an eye towards appropriate valuation. So you don't want to chase things at any price, but if you can buy real assets at reasonable valuations compared to historic norms or compared to a discounted cash flow analysis
Yeah.
model, then those are pretty good long-term assets to hold.
Mm. Yeah, so you have in your portfolio, for example, like 20% emerging markets, which is interesting. I think it's a good choice. But what would change your view on emerging markets if we have a stronger dollar, for example?
So that would be like the key risk for emerging markets. And
Yeah.
so basically, you have a little bit of a diversifier there. And so if the dollar goes down, you generally would expect international equities to outperform U.S. equities, especially on a dollar basis as a dollar-based investor. And so emerging markets, generally, if you look at, say, relative valuations, over the past 5-10 years, the United States has outperformed almost every other market.
Yeah.
Our valuations are higher than average and higher than comparable companies in other countries. And whereas emerging markets, they've been in generally at this point, probably like a 14-year consolidation. They had, a really high peak in 2007. They've been kind of in this big choppy sideways pattern for a long time. They kind of crashed in the recession. They came back. Then they had this big consolidation. They had a really good year in 2017 when the dollar weakened. They had a rougher year in 2018 when the dollar strengthened. And they've had this kind of choppy experience. And I do think that longer term, they're a pretty good hedge against a weaker dollar. It's also where the majority of global growth is, the majority of population is, and so of course that doesn't translate necessarily into good shareholder returns if you start at a high valuation. So, for example, from 2007 till now, emerging market GDP did very well. So those economies grew as a share of global GDP, but their stock markets did very poorly, most of them at least, because they started that period from an overvalued state. Whereas now, many cases their valuations are more reasonable. And so even though there are risks, there are risks related to their exposure to the dollar. Many cases, you're obviously dealing with political or economic environments that are less stable than you would find in the United States or Japan or parts of Europe. And so, but I think that at these current prices, many of those countries offer reasonable risk-adjusted return potential.
Yeah, definitely. So like you mentioned already, the US market, the stock exchange is pretty much very expensive or overvalued, even Buffett indicator, if you look at that, or Schiller ratio. Every chart shows you it's overvalued, it's overbought, it's the most expensive market we've ever seen. So what do you think about growth stocks? Because you also invested in some growth stocks. Don't you think in that growth stocks are going to fall a little or overvalued?
I think many of them might. And so, for example, I've been pretty critical on Apple at current prices. I think that's one of the more overvalued ones. One of the ones I've been holding on for a while is Microsoft. And so, it's gotten expensive at times. I've always kind of resisted the urge to sell it. I've kind of let that. I've had a pretty high valuation allowance for that company because it's so strong. But even that one now at this point is getting pretty stretched. So it's kind of on my watch list for potentially rotating out of the portfolio at these valuations. And so I think it kind of comes down to the individual stock in question. And so, for example, Facebook is no more it doesn't really have a higher valuation now than it had, say, 4 years ago. So that's kind of just kept up with its cash flow growth. Now, obviously, if there were to be regulation against it to hurt its cash flows, the stock price could go down. So that's a risk. But in terms of valuation, if you look at, say, the price to earnings to growth ratio, so the PEG ratio, it's pretty reasonable, both compared to their history and in absolute terms. So I don't consider Facebook to be super highly valued. Same thing for, there's a couple kind of mid-cap growth stocks that I find that even though they have high valuations in absolute terms, compared to their growth rates, it's pretty reasonably justified. And so there's generally kind of mid-cap growth that I find interesting and a handful of the large cap growths. But some of the really large ones like Apple and then now increasingly Microsoft and Google's on the expensive side now. Those I think are at risk of, say, they don't necessarily have to come down because you could correct in time or space, and so you could go down in prices, or you could just kind of chop along and go sideways for a few years as fundamentals catch up and they just kind of underperform other types of investments.
So, Lyn, do you think bonds need to be in a diversified portfolio in 2021?
Not necessarily. I mean, I think it depends on the investor's age, goals, things like that. And so basically, the advantage of having some cash or bonds is that, when there's a correction of various types, you have the capacity to kind of rebalance into that. And so it kind of aids in, say, dollar cost averaging or rebalancing back into things that are cheap. And so it basically provides that's, some degree, a peace of mind. On the other hand, if you're an older investor, you generally have an even lower tolerance for volatility, and you have kind of a shorter period of time where you need your money to kind of hold its value. And so generally, you still want inflation hedges to protect all your bonds and cash, but generally, you can't have, say, a pure stock and commodity portfolio if you're 90, for example. And so, different investors have different kind of circumstances. Generally, I think young investors can get away with, having more risk in their portfolio and having either zero bonds as long as they're mentally able to withstand that volatility, able to know what something's worth, able to, they have cash flows that they can buy more if it were to get cheap, or they can, deploy those cash flows elsewhere if things are expensive. So yeah, I don't think bonds are essential for everyone, but they do still have some roles, even though, I don't particularly like those assets in the longer run.
Yeah, let's talk about commodities. Do you think we're in a super cycle?
I think there's an increasingly good chance we're in a super cycle. But even super cycles don't go in a straight line. And so
No.
it's not like You don't just go straight up. You could have some pretty
Never.
wicked, like if you look at the the big, say, gold cycle from the early 2000s all the way up to that 2011 2012 peak. You had some pretty nasty drawdowns,
Yeah.
especially around the that 2008 period. And so I think that I expect the 2020s to be a very good decade for commodities.
Yeah.
They underperformed over the previous cycle. If you look at the capex cycle, many of them are a lot tighter than they were. And so I generally am in the bullish commodity camp, but I don't necessarily buy them at any prices. And so, for example, in 2020, I was pretty bullish on copper stocks, and I intended to hold them for a pretty long period of time. But then they went straight up. They just kind of they had a really big
Blow
reflationary
off.
move. Yeah,
Mm.
some of them more than tripled from those prices. And so I began trimming and then eventually, reduced my position. I still have some exposure, but not as, not nearly as heavy as I did. But even though I think, longer term, I think copper is likely to do pretty well, I'm just kind of always cautious when something becomes too consensus, went up too fast, becomes overbought. And so I kind of, rotate into some of the commodities at any given time or maybe, less consensus. But in general, I think that, a commodity basket is likely to do pretty well for a pretty long period of time here. I think that, even if you were to say, have a bad commodity year next year, for example, then I think the years after that would probably be another rebound. I think that basically, most of my kind of potential outcomes lead to a pretty good commodity decade.
Yeah, I agree. I totally agree. It was a whole chapter in my new book, and I recommend commodities as well. And I think we are in the super cycle. So which commodity you are most bullish on?
Yeah, so that rotates over time. I think, energy, oil is actually one of the ones that I like at the moment. And so, back in 2020, I was, you had kind of obviously a period of oil oversupply, right?
Yeah.
Because oil demand collapsed. OPEC had plenty of spare capacity. And so even though I bought oil stocks and had oil stocks, I wasn't sure how long they would take to recover, where I was, say, more bullish on copper. But because copper did very well, oil took longer to recover. I'm actually still pretty bullish on oil here and natural gas longer term.
Yeah.
And so I like some of the midstream companies. I like some of the producers. And of course, investors have different kind of appetites. So some people like the high cost producers that can have kind of these wild swings. I generally prefer kind of the longer term compounders that I can hold with lower turnover as they grow over time. And so I generally like oil here. Long term, I also like uranium. I think that's the market's in deficit. I think as utilities have to buy more uranium, basically the cost of production is below. The current prices are below the cost of production, so I think that has a long-term positive outlook. I've been bullish on them since October 2020, and it's one of those things. Even though they went up in prices, so I got a little bit less bullish than I was late last year, but I still think that the multi-year picture is very positive for them. And so I think there are multiple commodities like that have kind of good prospects.
Mm. Do you have any stock recommendation for our audience, or if you would have to buy one stock right now from the commodities, which one would it be?
I think it depends on the purpose. And so one of the ones I like to give is it's one of those ones that's not exciting to people, but it's called Enterprise Products Partners. And so what it is, it's actually it's a midstream partnership in the United States. And so, for example, they have infrastructure that transports natural gas liquids, petrochemicals, and a little bit of crude oil. They're better managed than most of the midstream, so they have low debt. They've historically allocated capital very well, and that's an investment I plan to hold for several years. If I then look instead towards producers, I've been pretty bullish on Lukoil, and so you have kind of low cost production in Russia. It's basically managed like a Western company, so it's managed like a European or an American
Yeah.
company, even though it's based in Russia, and they historically performed very well. They have some of the longest reserves compared to their annual production rates. They don't do destructive acquisitions, and so you have some jurisdictional risk there. So I like to spread out my commodity investments so that they're not all in the same jurisdiction. I like having some U.S. ones. I like
Cool.
having some European ones. I like Canada. I like Russia. And for example, speaking of Canada, I like Canadian Natural Resources. I think
Oh,
that's a it's a decent long-term play. They have long life reserves. A lot of capital is put up front, but now they have pretty competitive economics there, pretty good free cash flows. And so I think there's a bunch of investments like that can do pretty well in the long term, because I think we're in a somewhat of a tighter energy market for the next, call it 5 years.
Yeah, very interesting. Thank you for the insight. So let's talk about digital commodities. You got a background, like you said, in electrical engineering, so no wonder you're into cryptocurrencies. And you have been very vocal and being very bullish about Bitcoin, rather skeptical on Ethereum. Like in your post, you wrote about proof of stake and everything. I have to recommend it again. So you have to read this piece from Lyn on her blog. I will definitely put a link in this description. So what do you think? We saw some up and downs. Is the 4-year cycle over, or do you expect a blow off and the bull market to continue?
So I think, I've been analyzing the fundamentals. They still look pretty good. The price action's obviously been pretty weak lately. And so, I've covered digital assets for a few years now in kind of different bullish and bearish capacities. And so when I initially kind of started publicly covering it in late 2017, I actually passed on it. I basically liked the technology, but basically the risk reward did not look very good there, and so I passed on it. And then we had that blow off top. We had a crash. We had a multi-year consolidation. I saw the fundamentals continue to improve. Some of my questions were answered about the space. We saw basically answers like a clarification of some of the risks I saw, and so I became very, very bullish in say 2020. And then as we moved into kind of the more euphoric period in 2021, even though I remained structurally bullish, I started to get somewhat more uncertain and more cautious, viewing the investment as somewhat less asymmetric. But now we've had this big correction, and so it basically increases my bullishness here compared to where we were at, say, the high levels in April of this year. And so I'm looking at the fundamentals, like for example, development on the Lightning Network that I think is really kind of hitting critical mass. It's really kind of been in many ways a non-story for the past 2 years.
Yeah.
But really over the past 6 months, Lightning, I think, is all of those years of building, I think, are kind of coming to fruition now, where the usability is going up, the use cases are going up, the apps are coming out for it, and so you kind of went from a theoretical type of framework to a more practical market. And so I like the fundamentals there. I think one of the things we're seeing now that I think is complicating price action is that we're seeing a lot of hash rate migration out of China.
Yeah.
And so China's, they've quote unquote banned crypto multiple times, and it's always, it generally doesn't have a lot of teeth to it. But it does seem that this latest ban on mining actually is being enforced at a more aggressive level. And so we're seeing a lot of Chinese miners shut down,
Yeah.
either sell their machines or transport their own businesses to other mining jurisdictions. It could be the United States, could be Kazakhstan, could be Russia, could be Iceland, could be, just a bunch of different jurisdictions, wherever they can find cheap electricity in a reasonably, friendly jurisdiction. But that of course has disruptions, because some of those miners, they didn't plan for this expense, right? So some of them have to maybe sell some of their Bitcoin in order to fund all of this.
Yeah.
And also just generally, the hash rate represents the security of the network. So when that goes down, generally there's a correlation between price and hash rate. I think there's arguments about how which one's more causation than the other. But in general, we're just in a period of kind of uncertainty at the moment. But I think if you have a long-term view, you're kind of paying attention to the network effects. I still think the long-term story is intact here, even though I don't really have a firm view on, say, the next 3 months, next 6 months. I'm viewing it more as a buy and hold position. And then if it starts breaking above certain levels, I would then become more tactically bullish again.
Okay. Which level would that be? Like 42,000, or is there a price target?
Somewhere around there for Bitcoin. Yeah, we basically would need to see kind of a series of higher highs, higher lows, kind of an end to this consolidation. We've basically been hitting, for a while we were hitting lower highs, lower lows. We started to briefly hit a higher high there, but then we hit another lower low. So it's kind of a false kind of a breakout. And so we'd have to see a somewhat more sustained breakout, ideally to the mid 40s, before that, you can basically get momentum investors back on board, become more tactically bullish, even though I remain, say, multi-year structurally bullish.
Okay, so let's finish off with some rapid fire questions. What will be the best investment in this decade?
I mean, in percent terms, there's always going to be some like small biotech stock that goes up, 10,000%, or some altcoin that goes up some crazy amount. But generally, if you restrict it to investments that are already worth billions of dollars, I think Bitcoin's probably going to be one of the better investments.
Okay.
I think probably a handful of say commodity investments like uranium stocks, I think, or certain energy stocks that I could think could do very, very well. A handful of say current mid-cap tech stocks that happen to have long growth runways ahead of them. The problem is it's hard to find the winner, but if you do find the winner, I think basically we'll look back and find that a couple of those mid-cap tech stocks were just massive outperformers.
Cool. Fiat or gold?
I mean, I'd prefer gold in most circumstances. I mean, fiat is for having money to spend in the near term. Gold is a better savings technology.
Gold or silver?
I like both. I mean, gold is more pure money. Silver is a hybrid money, so it's part industrial, part money. It's got a lower stock to flow ratio. It has more use cases because it's cheaper enough that it can be used for more things. I like both. I mean, I guess silver is more interesting to me in many ways, but I like both. It's hard to say which one.
Gold or Bitcoin?
Again, I like both. And so
Same
there's a
here.
lot of there's a lot of people out there that, a lot of Bitcoiners don't like gold investors. A lot of gold investors don't like Bitcoin. I like both, and obviously there are times where one performs well and the other one performs poorly. Then they switch. An advantage is Bitcoin's more portable. Bitcoin has higher potential returns, whereas gold is much lower volatility. Much lower tail risk. Things like that.
Okay. What do you think? Will be a fiat currency still the world reserve currency in 2030?
I think it'll be a world reserve currency. I think basically what we're shifting towards over time is that the U.S. share of global FX reserves is decreasing. It's been decreasing for about 20 years now. I think it's going to
Sure.
continue to decrease. And then more recently, in just the past couple of years, we've had more trade happening outside of the dollar-based system. And so, for example, Russia is selling oil in euros to a couple, a number of different countries. And so I think overall Eurasia is shifting more towards euros, more towards potentially the Chinese yuan, and more towards even rubles in some cases. And so I think over time we'll shift towards almost all oil pricing happening in dollars to oil price happening in say dollars, euros, and yuan. And so I think that the dollar will be a regional reserve currency, one of the global reserve currencies, rather than kind of the main one as it has been.
Okay. Which country will be the next number one? Will it be China, the US, perhaps stays in number one, or a totally different country? What do you think?
I mean, I think it depends on what way you measure it. I mean, China has the largest population. Eventually, India looks like it'll clip China in terms of population. In terms of GDP size, China is projected to eventually become the largest country by GDP. And now one of the kind of the challenges China has, obviously they have worse demographics than many other countries
Yeah.
because of their previous policies, their overpopulation, and then two, they have weaker geography than the United States, for example. The United States is kind of ideally suited in terms of geography, and so I think as we go forward, in all probability, China will probably be the largest economy. But that doesn't, necessarily mean it has, say, the largest military reach, for example. And so I think, in terms of military, you'd have China, Russia, and the United States, and then, NATO as a whole, basically still being the leading players for a while. But in terms of actual kind of raw economic size, I think it'll probably eventually China, unless there's some sort of major tail risk or collapse.
Well, we started with the cycles and we talked about the fourth turning, and we are in the winter, definitely in the winter time. So winter is coming, winter is here already. So we all know that the cycles sometimes end with turmoil or even war. Do you expect a war in the next couple of years between some major countries?
I mean, in the next couple of years, I would guess no. I mean, basically, war is one of those things that, especially between major powers, is almost by definition a low probability event in any given year. But then if you look at enough decades, then the probability obviously goes up quite a bit. And so obviously some of the potential hotspots involve Taiwan, for example. and some, basically maybe the possibility for energy security. And so, there are some hotspots that I think if you look out far enough, they become an increasingly likely, way, that war could break out. But essentially, we're in this environment where, it's nuclear powers don't exactly have a very high incentive to go to war with each other. And so, I would not expect war in, say, the next few years. But, when you have, large debt bubbles, when you have, say, resource constraints, right? So the past decade's been a period of generally commodity overabundance. If you go into a period of commodity shortages, countries are more likely to make extreme decisions in some cases, especially if they feel like they have to rather than they just want to. And so I do think that the probability rises as you go into the future.
Okay. So what was the most important book you ever read?
I would probably say Lessons of History.
Okay.
It's like 100-page book that covers like 5,000 years of human history, and it's kind of just these people searching for kind of what they can summarize from it. And sometimes they'll look at a situation, they'll phrase it one way, and then they'll kind of flip it on its head and look at the situation from the kind of the opposite perspective and kind of rephrase it. And so I found that book pretty interesting.
Cool, cool. The last question, and it has nothing to do with commodities or investing or money or the Fed, is what is the meaning of life for Lyn Alden?
I think to just experience things, basically do what I can to make, life better for those around me, enjoyable for myself, and then just, basically express myself in ways that, kind of are true to me and that help other people. And so I try to live my life in a way that's, high integrity, that, basically is something that I can feel good about at the end of the day.
Yeah, cool. So, and you did a great job on this interview. It was terrific, definitely. So where can people find more about you?
So I'm at lynalden.com. People can find my work there. I'm also active on Twitter at Lyn Alden Contact. And so, feel free to reach out.
Definitely, we will. Lyn, I would like to have you again on the show. It was just mind-blowing. It was a great pleasure having you, and I hope you enjoyed it as well. So thank you very much for your time and for your insights.
Thanks so much for having me.